oh, this is the end, real estate is falling off a cliff, so houses aren't selling, which is just in time for the Federal Reserve to be cutting rates after supposedly winning the war against inflation. This is what at least I have wanted to create a more healthy South Bay real estate market. Hello, everyone, and welcome to another edition of the Richard Haynes Real Estate Show. It is September 18th, 2024. It feels like fall, even though it was 100 degrees 3 weeks ago. There's definitely a crisp in the air. I hope everyone's enjoying back to school, the new seasonal change, and tons of football. We are starting off another show with some hot off-the-press news. Today, just a couple hours ago, the Federal Reserve announced a half-point cut to interest rates. That is the biggest news of the moment. That's going to be a hot topic that we cover today on the podcast, in addition to inventory. So we're excited for you all to join us. For those of you who are listening for the first time, I'm Richard Haynes, your host. Here at Haynes Real Estate, we're a small boutique brokerage here in the South Bay of Greater Los Angeles, where we cover the Palos Verdes Peninsula housing market, Hermosa Beach, Redondo Beach, and Manhattan Beach housing markets. So thank you for joining us. I'm doing another microcast, just me individually. I know one day we will bring back guests for all of you because I know you enjoy that. But for now, we're pumping out the most pertinent data for you to gobble up here in 15 to 20 minutes time. And just to reiterate again, we have two topics: the Federal Reserve cutting by a half percentage point, which is more than a quarter point, where a lot of people were expecting that. I'm going to cover that in topic number 2, but we're going to kick things off with topic number 1, which are South Bay home inventory levels. This is incredibly important. For those listeners who have heard me beat a dead horse over time, the main item is we need more supply, or again, inventory, which means homes for sale. We have this horrible affordability crisis because supply is low. Homeowners are locked in with their low interest rates. If we can have naturally rising supply, because we have been at historically low levels, more supply will keep prices in check. It will give buyers more options and just establish a more healthy housing market that we deserve to have here in the South Bay, in California, and beyond. So let's get right into these inventory levels, because the past couple of years, inventory has been exceptionally low, if not historically low, and it's been brutal. But if any of you also happen to follow my blog, you know that there may be some cracks in the armor of low inventory. Yes, there may be light at the end of the tunnel, because for the first time in a long time, we are starting to see inventory levels rise, which is a great thing to see in the South Bay. I had a lot of people talking to me about how they felt inventory was rising, but I had not dug into the data, and we did that last week, and boy, oh boy, it is up. So I'm going to blow it for you so you know the general theme, but then I'm going to dig into the detailed numbers so you can hear about your local housing market or whatever market you're most interested in. But as you know, we cover on this podcast and the blog Palos Verdes all the way to Manhattan Beach. And of the cities in between those markets, all of the cities saw rising inventory, and in many cases, fairly significant jumps in rising inventory, with the one exception being Palos Verdes Estates. So the South Bay market as a whole is absolutely seeing rising inventory, which is great news for buyers. And even if you're a seller, we aren't seeing prices fall, but it's just nice to have a healthy market. It doesn't make sense to have multiple offers every single day and having people banging their heads against the wall. So let's get into the detailed numbers here. Let's start with Palos Verdes Estates because that's the only one that didn't see its inventory rise. I took, so that you guys know the numbers, I took August of this year, 2024, and compared it to August of last year to stay consistent with the seasonality and to just show any sort of jumps year over year. So Palos Verdes Estates, inventory is down. It's the one city that has down inventory. In August of this year, it had 46 listings versus last year, 50 listings on the market. Getting into the rising markets, Manhattan Beach inventory is up, you guys, 11.2%. That's a great sign for Manhattan Beach. It is the most expensive market in the South Bay outside of small rolling hills. And to see a double-digit jump in Manhattan Beach from the summer going into fall is great news for that very expensive town. Now, the next two cities I'm going to be bringing up here, hold your breath because the inventory level jumps are insane. Redondo Beach up over 70% and Rancho Palos Verdes up over 70%. You guys, it was a pretty incredible jump in both of those areas. I'll give you an example because I'm not going to run through all the numbers. Rancho Palos Verdes last year in August had 79 listings. It has now jumped up to 136 listings. Now, is this something to sound the alarm? Are we having a recession? Is there way too much inventory or foreclosures coming? No. But a over 70% jump in inventory levels is a steep jump. Now, in Rancho Palos Verdes, that could be attributable to some landslide movement over on the southern side of the hill. It also could just be that we were at historically low levels for RPV, and we are still lower than its long-term average, but seeing a big jump like this is something to keep our eyes on. Rolling Hills Estates inventory up 21.1%, which is just 4 more listings than last year. It's not a huge market. And then Hermosa Beach inventory is up 29.3%, 53 listings this year versus 41 listings last year. And then the most expensive housing market in the South Bay, behind the gates in Rolling Hills, is up 200%. We're not going to put too much emphasis on a market that has 12 listings versus 4 listings and its median price is $6 million. But when we have bigger data towards the end of the year, we'll talk about inventory levels there. But essentially, to put a bow on all this for you guys, Manhattan Beach is up a nice, healthy double-digit number. Redondo and RPV have jumped pretty sizably, but that's coming off historically low levels. And then you're seeing 20% or so jumps in Redondo and Hermosa Beach. So you guys, a lot of people go, oh, this is the end. Real estate is falling off a cliff. Hey, maybe you're right. I'm not seeing that. We're not seeing crazy price reductions, but we are now seeing rising inventory in the data. And this is what at least I have wanted to create a more healthy South Bay real estate market, and it looks like we're starting to get that. The higher interest rates are finally maybe pushing inventory up, and people can't afford them, and so houses aren't selling, which is just in time for the Federal Reserve to be cutting rates after supposedly winning the war against inflation. So those are the inventory numbers. We'll continue to track it for you. Next month will be the end of Q3, so we'll have median price numbers for you, and I'll do a 3-month average of inventory levels to see if the data is consistent with rising inventory throughout the South Bay. So give me 2 more weeks and you'll have another chunk of nice data on a quarterly basis. So moving on to topic number 2, we're going to the Federal Reserve. Jerome Powell, the Fed Reserve president, the Federal Reserve chair, as they like to call him, had their every 6-week conference today to talk about if they're holding, cutting, or rising interest rates. And it was widely expected widely telegraphed that the Federal Reserve would be cutting rates today. I want to say Wall Street had like as good of a 90% to 95% chance that the Federal Reserve would cut rates today. The big question was, would it be a 1/4 point small rate cut or a larger chunk of 0.5%? I personally thought they would cut a 1/4%, but instead today they cut a much larger 0.5% rate. And I think the reason being for the Fed, people are starting to see some cracks in employment. People have said the inflation war is supposedly run, and I think the Fed wanted to cut to get ahead of any recessionary items and not have it get too far beyond them, and then they can cut smaller over the next 2 meetings to close out the year. Now, the big question I always get from clients is, wow, the Fed just cut 0.5%. I was getting quoted a 6.25% rate. Am I now getting a 5.75% rate? The short answer is no. This was widely telegraphed. The market put a 95% certainty on a cut. So mortgage rates are their own beast where they move based on the market, and they had already moved down over the last month or two on lower rates in this anticipated rate cut. In fact, mortgage interest rates on the 30-year rate hit its lowest level on Monday in the past 2 years. So rates have been coming down in anticipation of this cut. So it's what they like to say is the cut was priced into mortgage rates already. So the answer to everyone going, this is amazing that the Fed was cutting rates. I just got a text from a client who went, the Fed cut by 0.5% today. It's going to lower rates and raise my home value. And I'm going to have to text him back and go, no, it hasn't, because the rates have already been coming down the last couple of months. And we already had someone lock in a 5.75% rate in this anticipation. Now, what's interesting here and what we want to look at is the Fed also releases something called a dot plot. And I'm getting really nerdy on all of you guys who don't follow the Fed or aren't real estate professionals. But the Federal Reserve dot plot takes voting from every member of the Federal Reserve, and they vote on where they think interest rates should be in the future. And it takes each person's dot, and I have the chart right here, and they release that as well every 6 weeks. And what the votes show is most of the members of the Federal Reserve look like they want rates to come down another 0.5% before the end of the year based on these votes. And we have 2 more meetings. It's every 6 weeks. So it's more than likely we'll get 2 1/4 point cuts or get 1 additional 1/2 cut and no other cuts. So this new dot plot release is actually the juicy information that will drive rates lower or higher. And so if people are expecting a 1/4 point cut today and then 2 more 1/4 point cuts, well, that would be 0.75% in cuts. We got a 0.5% cut today, and will likely, per the dot plot, get another 0.5%. That could be 1%. So I could see with this new release, rates from where they are today could come down another 1/4 point. That wasn't anticipated. So give it another month or 2. And if you're being quoted a rate at 6%, you'll likely get it at 5.75. So if you guys really want to nerd out, just Google Federal Reserve dot plot. You'll see where they're going. You can see those votes. And hot off the presses, a 0.5 point cut today. How does that affect our market? Not really, because people and clients of mine were already locking in rates the past couple weeks that figured a cut was coming on this very day. But I don't want to pour cold water on this. This is a great thing for the market in the right direction to help homes become more affordable. And if we're finally starting to see rising inventory, it's nice to see lower rates to have buyers meet the demand needed to gobble up that inventory that is steadily rising. So there you guys have it. Kind of a nerdy, data-driven podcast this week. We covered the Federal Reserve cutting rates by 0.5 point. Really kind of it's a big event always, but it's kind of a non-event in my mind because mortgage rates have already come down. People expected it. But number two, really the rising inventory is the big news, you guys. And if we see that continue here through September in the data, that's going to help loosen up prices a little bit. That's going to get our markets healthy. And it could be the perfect storm for a quote unquote soft landing in real estate and somehow dig our way out of this horrible affordability hole and actually get back to a market that makes sense for both buyers and sellers. So I hope you guys enjoyed this edition of the Richard Haynes Real Estate Show. Thanks for always coming by and visiting. We'll be recording another podcast in the next 1 to 2 weeks, and we'll see you next time. Take care.